In this video, traders, we're going to look at little clues that we can spot to see that whether a stock has been hammered purely from market sentiment or whether it's been hit because we believe that the company is going to struggle in the future. Stick around. Hey guys, warm welcome to you. All right, so there's in my opinion, there's two different things that are happening right now when we're having this market volatility. Market is under significant pressure from coronavirus. This is perfectly valid under other times as well. And also, in bull markets, slightly opposite, but the same kind of thing. Now, market tends to drive everything, right? There are certain exceptions. You get some stocks that just buck the trend completely because they're completely uncoupled from the market. But generally speaking, market, regardless of how good the company is doing, the market will dictate the price of that stock. So if the market's down, the stock will probably be down. Even if it's a solid company, even if the earnings are good, even if the earnings are never going to be bad, even if they've got solid growth, all this market share, all the things that people like to see, even if that's the case, the stock valuation will still be lower, hence the share price is lower. Tends to be kind of almost 70% of the market, maybe 20% for the sector, and the last 10% just for the individual stock as a broad thing. So you think about if the market's weak, the sector's weak, even if the stock's the best stock in the world, it's still going to struggle. So that being said, how do we look at clues to see that potentially the stock that we're looking at is just hit because market sentiment is bad? And if market sentiment changes again, they might be the first ones you go to buy, versus companies that have been hit not only from market sentiment, but also because their earnings are going to drop, because their prospects are looking poor. There's two distinct different things, I think. And if we can look at the clues, maybe it will help us guide us for any longs, if we want to look for some longs at the bottom, any shorts, we want to get aggressive on shorts, pushing even deeper into this crisis, all that kind of stuff. It helps us judge it. So hit the screens now, guys, and what we'll do is we'll look through some stocks and kind of see some of the attributes of stocks that maybe, again, we're kind of making a bit of a guess here, but maybe are exhibiting just sentiment-based weakness as opposed to company-based weakness combined with sentiment-based weakness. Let's go. All right, traders, let's go to my main watch list here. Okay, so we're looking for stocks that have, if we look at the broad market, right? So we look at the broad market. Let's just go to the SPY as an example. Right, SPY started rolling over 20th of February, and you can see significant drawdown. I mean, some of the European indices are even worse. Nasdaq's a little bit less, but regardless of that, let's have a look and see. So that's the order of magnitude we're looking at. So what we can do now is we can start to look and see how some stocks have fared. And actually, if you look at this SPY, we're down now at kind of end of 2018 lows. Okay, so now we start to look at some of the stocks like Apple, for example. Now, of course, almost every stock has been hit quite hard. But when you're looking at the likes of Apple, you could argue, and again, up for argument and purely based on perception, that this movement, regardless of the percentage-wise, has only taken us back to where we were at the end of last year, as opposed to the end of 2 years ago. So you could argue that actually this is purely sentiment-based, and maybe they will take a hit on some sales of phones and stuff, but are they innovative enough to recover? Have they got Apple TV? Have they got the App Store? That kind of stuff? Possibly. Same with Amazon. Amazon's come off the high after a big spike, but that kind of thing. And then we've got the same, we can look at other stocks like, maybe Disney's a good example, because even though they may have the parks closing, which might have an impact, you could argue that they've got other revenue streams that are far more effective. And if we look at things like Facebook's a great example, because they shouldn't have no negative impact really from the virus. People are staying at home, people are still going to be on the mobile, people are still going to be browsing bits and pieces, people are still going to be posting updates. Maybe they won't be posting so much because they're not on holiday. I don't know, is that scraping the barrel? But these guys have been hit. And if you look at where they've come down to, we start to see, okay, well, they've undone a little bit of work, but are they going to be strong? Now listen, this is not it's not a science, but you can start to think, okay, what does the company do? Is it affected? Now obviously look at the cruise liners or the airlines, they're going to get affected. But if you're looking at other companies, you can start to pick off some companies that maybe are just weak because the market's weak. Maybe they're just weak because everything else is really under the cosh. Microsoft is a perfect example in my eyes that, are they going to do worse? Probably not. They might even do better, but the sentiment has taken them down from 190 to 140. Now, if you start looking at cruise liners, then it's different because the sentiment is there, weak sentiment. It has been even before we started. When it kicked off on the 20th of February, we've gone down from 45 to 15, and we're multi-year lows, and we know why. Because not only is the sentiment bad, but the sector's horrendous in this environment, and they are going to struggle from a profit and a revenue perspective, as well as the market sentiment. So, and then we could look at stuff like, the casino resorts, for example. I'll bring this up before. Same kind of thing. Yes, the market's hammering these, but the sentiment is hammering these, but they're just less, they're going to make less money. They're just going to make less money purely because people aren't going to be in casinos. They don't want to be in a casino. So there's all these reasons, guys, all these things to look at. Tesla, you could argue one way or the other with Tesla, to be honest. Some people would say, oh, they're going to get a haircut because no one's going to be buying cars, and that makes perfect sense. Others are saying, well, maybe there'll be a slowdown, maybe they'll kick back up. But you get the idea. The point is, we look at the chart and we see how far it's come from the high. We look at where it is in relation to maybe the underlying market that it's in, or the underlying exchange it's in, or index, should I say, that it's in. And then we make a judgment and we go, okay, well, actually, this stock was doing really, really well. It was a favorite. It was at highs when we were all at highs. It's come off now. It seems to be less vulnerable than others. And I'm not recommending buy Apple, but just pointing out from a chart perspective, how far has it come down relative to the underlying market? How far has it come down relative to its peers? Is that going to be one of the stocks that immediately attracts buyers as and when, or if and when, we come out of this and start driving higher, versus a stock like Carnival, for example, which will only attract buyers, you could argue, if they find some way of really recovering after this, and if they recover quickly, and if they start to see revenue come back in, or if they start to do this, that's really based on the company as well as the sentiment, versus other stocks out there like your Apples, like your Amazons, like maybe your social media stocks that maybe are literally only being hit because of the sentiment, and actually the business model is still sound and will take a very, very minor blow from it. So, all right, guys, let me know your thoughts on that. What do you think is a strong stock at the moment? Let me know in the comment section below. If you've got a stock you've been watching that's strong, we've got a video we talked about working from home stocks, should be up soon if it's not already. We talked about some of the stocks that could benefit from that. You would have thought that gold would be a little bit better in this environment. It isn't. Who knows what's happening there. Crude oil as well has been hammered, so all those have been very, very smashed. But let me know your thoughts, guys. Do you think there's something that's really, really weak out there that shouldn't be, that maybe has been affected purely because maybe there's liquidity? There's a lot of stocks out there that hammered, and you think that's got to be liquidity as opposed to value, genuine valuation concern or genuine profit concern. And there's also stocks out there that have barely budged in the scheme of things, that are probably poised for a big rip to the upside when they get through, because they've got enough cash to weather the storm, they've got enough revenue, got enough profits, very cemented, good moat around their business model, all that kind of stuff. So when sentiment does eventually change, they might be the ones that are first to go to. Stick in the comment section below, we can build a decent list, and we'll redo another video later on. Take care, guys. Bye-bye.